Imagine for a moment that you are looking at a chart of the world's most critical resources over the last 40 years. Real estate, up. Stocks, up. The cost of living, up. But what if I told you that map is wrong? There is one asset, a critical strategic metal, that is priced lower today, in nominal terms, than it was in 1980. If adjusted for inflation, it should be trading at over $170 an ounce. Instead, it struggles to break 30. This isn't a lack of demand. We are consuming this metal faster than we can mine it. It is the lifeblood of the green energy transition and the backbone of the digital age. So why is it cheap? What if I told you that the price you see on the screen is a carefully constructed illusion? A synthetic price manufactured by a paper market that is detached from reality. This isn't a glitch in the system. This is the system. Hello, and welcome back to AI-Powered Studio. I'm your Dallin, and today we're tackling one of the most complex systemic mysteries of our time: the suppression of silver. When most people think of silver, they think of coins, jewelry, or perhaps a second-place metal. But in the halls of global finance and industrial planning, silver is something else entirely. It is a strategic imperative. It is the most conductive metal on Earth. Without it, the solar industry collapses. The electric vehicle revolution stalls. The military-industrial complex goes blind. Today, we are going to look at the deep bifurcation of the silver market. We are going to expose the mechanism of the paper short, how billions of ounces of silver that do not exist are traded daily to determine the price of the few ounces that do. We will investigate the Silver Rule 7 change that crushed the Hunt brothers, the modern domination of banking giants like JP Morgan, and the terrifying reality of the LBMA inventory drain. The mystery of the shadow economy forces us to ask a fundamental question. Is the price of silver being artificially suppressed to subsidize the tech and green energy sectors? And if so, how long can the dam hold before the physical reality breaks through? Welcome to the Deep Dive. Today, on AI-Powered Studio, we are exposing the silver squeeze. To understand this manipulation, we must first understand the architecture of the deception. We need to talk about the difference between silver and a contract for silver. Let's look at the extremes. In the physical world, silver is finite. It must be mined, refined, minted, and stored. It costs energy and labor. But in the financial world, specifically on the COMEX in New York and the LBMA in London, silver is digital. It is a promise. Here's a fact that should keep you up at night. For every 1 ounce of physical registered silver sitting in the COMEX vaults, there are often hundreds of ounces of paper silver traded against it. Some analysts estimate this leverage ratio has hit extremes of 100 to 1, or even higher. This is what we call the derivative dog wagging the physical tail. The price of silver is not set by you buying a coin at your local dealer. It is set by the trading of futures contracts. Banks and hedge funds trade these contracts in milliseconds. They can sell millions of ounces of silver in a matter of seconds, without ever touching a single bar of metal. This brings us to the concept of naked shorting. Imagine you are a massive bullion bank. You see the price of silver rising too fast. You don't need physical metal to stop it. You simply issue thousands of short contracts, promises to sell silver at a future date. The market is flooded with this paper supply, and the algorithm reacts instantly. The price crashes. We see this repeatedly. Massive dumps of paper silver, often equal to a year's worth of global mining production, sold in a vacuum of minutes. But why does this work? It works because the vast majority of traders never ask for delivery. They settle in cash. They are betting on the price, not buying the metal. As long as no one asks for the real silver, the game continues. But what happens when they do? To understand the present, we must look at the past. We must look at the year the system almost broke. 1980. The Hunt brothers, Texas oil tycoons, realized that the dollar was losing value. They looked at the map, and they saw that silver was undervalued. So they didn't just buy futures contracts. They took delivery. They bought physical silver. They moved it to Switzerland. They moved it to Delaware. They removed the supply from the market. The price responded. It went from $6 to $10 to $20 and eventually touched nearly $50 an ounce. In today's money, adjusting for inflation, that is roughly $170. The banking establishment panicked. If silver kept rising, it would expose the devaluation of the dollar. It would bankrupt the short sellers, the banks who had bet against the metal. So, what did they do? Did they let the free market work? No. The exchange changed the rules in the middle of the game. They introduced Silver Rule 7. This rule stated that traders could no longer buy new positions. They could only sell to close out existing ones. Imagine playing a game of poker where the house suddenly tells you that you are only allowed to fold. You cannot raise. You cannot call. You can only fold. The price collapsed. The Hunt brothers were bankrupted. The message from the establishment was clear. You can play in our casino, but you cannot beat the house. This event established the psychological ceiling for silver. For 40 years, $50 has been the line in the sand. Every time the price approaches it, the paper shorts flood in, and the rules are tightened. But that was 1980. The players have changed. The stakes are higher, and the new whale in the market isn't a Texas oil tycoon. It is the bank itself. Let's talk about the legal shadow. In the years following the 2008 financial crisis, a new dominant force emerged in the silver market, JP Morgan. While the establishment banks were suppressing the price through the paper market, they were simultaneously doing something else. They were accumulating physical metal. In 2011, silver made another run at $50. Again, it was smashed down by paper selling. But in the wreckage of that crash, JP Morgan began to hoard. They opened their own vault. They accepted silver as payment for debt. By some estimates, they amassed a hoard of over 150 million ounces, the largest physical stockpile of silver in history, held by a private entity. This isn't a conspiracy theory. It is a matter of legal record. In 2020, JP Morgan agreed to pay $920 million to settle investigations by U.S. authorities into spoofing in the precious metals and treasury markets. Spoofing is the act of placing large orders to buy or sell with no intention of executing them, simply to trick the algorithm and move the price. They were caught rigging the game. But here is the twist. While they paid the fine, they kept the metal. JP Morgan acts as the custodian for the biggest silver ETF, SLV. They hold the metal that backs the public's investment. This creates a massive conflict of interest. The entity responsible for safeguarding the asset is the same entity that has been fined for manipulating its price. Why would a bank suppress the price of an asset they hold in such vast quantities? This is where the shadow deepens. If you control the supply, and you control the paper price, you control the market. You can keep the price low to accumulate more, or you can keep it low to serve a client even bigger than the bank itself. We need to zoom out. We need to stop looking at silver as money and start looking at it as a strategic material. Why does the system need silver to be cheap? The answer lies in the green revolution and the digital transformation. Silver is the best conductor of electricity known to man. It is essential for photovoltaic cells in solar panels. It is found in every iPhone, every Tesla, every Tomahawk missile. Let's look at the data. The solar industry's demand for silver has exploded. In 2014, photovoltaics used about 5% of annual silver supply. Today, estimates suggest it is approaching 20% or more. If silver were to trade at its inflation-adjusted high of $170 or $200 an ounce, the cost of producing solar panels would skyrocket. The cost of EVs would rise. The entire economic model of the green transition relies on cheap raw materials. If silver is free market priced, the Green New Deal becomes unaffordable. Therefore, the suppression of the silver price acts as a hidden subsidy. It is a transfer of wealth from the miners and the investors to the tech giants and the green energy sector. By allowing the paper market to dilute the price, the establishment ensures that Apple, Tesla, and Raytheon can source their raw materials at 1980 prices despite 2026 inflation. This is the ultimate shadow, a coordinated effort to keep the cost of the future artificially low by suppressing the value of the past. But there is a problem with this strategy. You can print paper contracts. You cannot print silver. Physics eventually defeats finance. We are now witnessing a phenomenon that the paper market cannot hide: the vault drain. Since 2021, the London Bullion Market Association, the primary vaulting hub for the Western world, has seen its silver inventories plummet. We are talking about a drop of nearly 30 to 40%. Hundreds of millions of ounces have left the vaults and have not returned. Where does it go? It is moving east. It is moving to India, where silver imports have hit record highs. It is moving to China for massive industrial application. And here is the crack in the dam. The Shanghai Gold Exchange often trades silver at a premium significantly higher than the COMEX price in New York. When the physical price in Shanghai disconnects from the paper price in New York, traders buy the physical metal in the West and ship it east. This drains the COMEX. Currently, the registered category of silver on the COMEX, the metal that is actually available for delivery, has hovered near historic lows. We are seeing a market that is running on fumes. We are seeing backwardation. This is a technical term, but it is crucial. It means the spot price of physical silver is higher than the future price. This should not happen in a healthy market with storage costs. It signals a desperate shortage of immediate physical metal. The paper market says there is plenty of silver. The warehouses say they are emptying. So, why does this matter to you? Because we are watching a slow-motion train wreck between an infinite supply of paper currency and a finite supply of physical resources. The banks have managed to hold the beach ball underwater for 40 years. They have used leverage, rule changes, and high-frequency trading to convince the world that silver is abundant and cheap. But the industrial machine does not care about paper contracts. A solar panel cannot function with a promissory note for silver. It needs the metal. If the vaults run dry, really dry, the game of musical chairs ends. The paper shorts will be forced to cover in a market with no sellers. The price discovery will shift from the computer screens of New York to the physical docks of Shanghai. This isn't just about making money on a trade. This is about the collapse of an illusion. I want to hear from you in the comments. Do you think the banks can suppress the price forever, or is the physical shortage about to break the system? And does the idea of your green energy transition being built on price manipulation worry you? If you found value in this deep dive, please hit that like button. It helps us bring these stories out of the shadows and into the algorithm. Don't forget to subscribe to AI-Powered Studio for more investigations into the systems that rule our world. Until next time, keep watching the data. AI-Powered Studio.